Hey everybody, welcome back to Whiteboard Finance. My name is Marco and I'm here to help you master your money and build your wealth. Today's video is actually pretty important because it talks about the less sexy part of investing, which is bonds and why the bond market is potentially at risk. But bonds do affect equities and vice versa. So it's important that you stay and watch this video. So we're going to talk about corporate bonds. We're going to talk about municipal bonds, meaning bonds that are issued by companies, bonds that are issued by a state or a municipality, like the state of California, for example. But for the sake of conversation, let's just keep this to all bonds in general. So we're going to talk about why they're at risk in this video. The thing that prompted me to create this video was this thread by Vishal. You can follow him at Vishal Invests on Twitter. I've been meaning to make a video about this because I have been talking about the corporate bond bubble for a couple of years now, especially when it comes to zombie companies that literally just exist to service their debt, which a lot of people are not paying attention to. So in this thread, I'm going to read it just because he basically laid out what I would have made a video about anyway. It's going to be probably a little bit longer of a video, but I think it'll behoove you to watch this and pay attention to it. So basically, in this thread, he talks about what are bonds in general, the risks to bonds that he's seeing and that a lot of other investors are seeing, and then also, is the bond market breaking? So this thread is about a week old, and I'll start right here. He's talking about how the bond market is in a difficult place with rampant inflation and interest rates on the rise, which they've risen even more since this video. Since this tweet thread, since March 16th, which you can see right here. You will likely start seeing a lot of headlines on how monetary policy will affect bond prices. And this person, Macro Elf, who I follow, he used to be a hedge fund manager. I think he managed a few $1 billion, according to his bio. He said investing in markets without understanding bonds is like eating soup with a fork. It's counterproductive. So the reason he says that is because, when I got my finance degree, one of the first things you start learning about is money supply, equities, time value of money, and then also bonds, not blondes. Blondes was extracurricular. Bonds are what was taught in class. But anyway, you start learning about face value, par value, the coupons, how much you get back, fixed income, things like this, which I'll get into more in this thread. So debt is money that is owed to by one party to another. The borrowing party will borrow the money with the condition that they will pay it back at a future date, usually with interest. So that happens with any exchange. Whenever you get a loan from a bank or from a person or a family member or whoever, if you're taking a loan, you promise to pay back their face amount, their principal amount, with some interest, saying, hey, this is the cost of borrowing that money. That's all loaning money is. That's how banks make money. So bonds are debt instruments that are commonly used by governments and corporations to raise capital. The borrower will issue a bond, and a bank or other institution will lend the capital to the borrower with an obligation to be paid the full amount plus interest at a later date. So this is important. Pay attention. The main components of bonds are the face value, aka the par value. This is the value that the bondholder will receive at maturity. So they're getting back the face value of the bond. So if it's $1,000, let's fast forward 20, 30 years later, or depending on whenever the note matures, they get back that face value amount plus, number two, the coupon rate. This is the annual rate of interest payable on the bond. So coupons are generally paid twice a year. And then finally, you have the maturity date, which I just mentioned. This is the date at which the money is loaned and will be returned. Longer maturities generally offer higher interest rates. If you want to extend that for a longer period of time, this gives the corporation or the municipality longer time to use that money, which they'll be willing to pay you more for at a higher rate, if that makes sense. So a quick example is that the face value of the bond is $1,000. The coupon is 4%. The maturity is in 20 years. So bank purchases the bond and they pay the issuer $1,000 today. In return, they will receive coupon payments amounting to $40 every year for 20 years. At maturity, the bank will receive the face value back of $1,000. Okay? So you can already start to see why this doesn't make sense in a high inflation environment, right? You're locking in a relatively safe low interest rate, but the rate of inflation is going to be much higher, okay? Historically, which we're seeing high inflation rates over the past 40 years, the highest inflation we've seen in 40 years. So the example assumes a fixed coupon rate, so coupon payments will not change during the entire lifetime of the bond. This is no different than a 30-year fixed rate mortgage, to give you an analogy. Many bonds provide variable or floating interest rates. The coupon rate will adjust accordingly to benchmark rates. If interest rates rise, so will the coupon payments. That's no different than getting an adjustable rate mortgage that's fixed to, LIBOR or prime rate or whatever, benchmark rate they want to use. So bonds versus stocks. So with common stock, which everyone wants to invest in because it's sexy and exciting, you own equity in a company and will receive any dividends paid by the company or obviously the growth or appreciation of the equity itself. Your stock's going up or to the moon, if you will. With corporate bonds, you do not own any equity. So you don't own a piece of that pie of the company. You receive only the principal and the interest regardless of how the share price of the company moves. So this is basically saying, hey, you are issuing debt, or the corporation or the municipality is issuing debt, the bond issuer, you're the bond purchaser, you're just giving them your money in exchange for a return of a fixed payment down the road until maturity. Okay, makes sense? So there are some risks with the bonds. Bonds are like any other investment that they carry risks. You obviously have the credit or default risk, meaning that the company can go out of business, the municipality could go bankrupt. This is why the creditworthiness of the company is an important consideration, and that's why we're going to talk about zombie companies later in this video. So with interest rate risk and bond prices, you have interest rates and bond prices. They typically have an inverse relationship. Okay, when rates go up, prices go down. When rates fall, prices go up. So it's basically just an inverse relationship. So why does this happen? So if interest rates rise, new bonds will be issued with higher coupon rates. Okay, you're getting compensated for that risk. So existing bonds that have lower coupon rates will be less attractive and will decline in price. Okay, why would investors want to take that on when they can get paid more with a higher coupon? So inflation risk is when investors who buy bonds are committing to receive a rate of return for the time that the bond is held. So as inflation increases, kind of like my savers or losers that I've been talking about for 2 years now, the real rate of return of the bond will decrease because the purchasing power is decreased. Current real rates for most bonds are significantly negative. This is huge, this last sentence right here. When you look at real rates, this is why people are flooding money into Bitcoin and other investments. I don't want to say crazy investments, but this is why the price of everything is exploding, because fixed income, it doesn't make sense right now to invest in it. So this is what the SEC has to say about interest rate risks. Let me open this up in a new window. You can see here that, this makes it particularly important for investors to consider interest rate risk when they purchase bonds in a low interest environment. Okay, just makes sense. It's common sense. Here's a depiction of the historically low interest rate environment that we are in right now. So this is a chart of the 10-year Treasury. Typically, 30-year mortgages or mortgage rates are tied to the 10-year Treasury. You can see since 1982, we've obviously been steadily declining, especially since 2007, 2008. This is when quantitative easing started, which I talk about in a lot of my videos. I don't want to beat a dead horse. But this is basically when we went into a federal funds rate of ZIRP, a zero interest rate policy, and it pretty much hasn't gone up since then, although rates are ticking up. 30-year mortgages are ticking up at the time of this recording. So all while inflation is hitting levels that we haven't seen in over 40 years, which I mentioned earlier, inflation which is being exacerbated by geopolitical tensions, aka Russia and Ukraine, and supply chain breakages, aka cerveza sickness, they are unlikely to resolve soon. So if I open up this chart right here, you can see the blue line is Consumer Price Index, CPI for all consumers. The red line is CPI minus food and energy. So you can still see it's ridiculously high. Moving on, credit ratings. A corporate credit rating assesses a company's creditworthiness, which shows investors the likelihood of a company defaulting on its debt obligations. I used to do this as a job, okay? I was middle market credit analyst at a publicly traded bank. I would review companies, not just their quote unquote credit score, but their credit worthiness. Companies don't necessarily have a credit score. Yes, there's Moody's, there's Standard & Poor's, there's Fitch, but typically you assess this by the health of their financials. So this is literally what I did as a job. So I would look at middle market companies all throughout the Northeast. I was basically in upstate New York, Syracuse, Buffalo, these kinds of areas. And it's pretty interesting once you start digging into companies' financials, day in and day out, you can see kind of like the writing on the wall on a lot of these companies, whether they're going to do well or not. I can only imagine during now cerveza sickness what these credit ratings look like. So highest rated investments should have the lowest default risk, meaning it's just like a human's credit score. So if I'm an 850 credit score, obviously the bank is going to lend to me and they're going to give me their lowest rate because I present hypothetically the lowest risk to them. If I'm a 500 credit score or a 550 credit score, that's showing the bank, hey, Marco has had some hiccups in his past. It may be risky to lend to him, so his rate is going to be higher. Okay, same concept. So junk grade bonds have a higher default risk, but should provide a higher return due to elevated risk. Exactly what I just described. So it goes all the way from basically AAA all the way down to BBB minus. Anything below BBB minus is basically considered a junk bond. Okay. So the funny thing is, in 2008, all these ratings agencies, which were obviously corrupt, were packaging up all these derivatives and all these different credit default swaps and CDOs and all that, collateralized debt obligations. They were giving them like AAA ratings, but when in reality they were dog crap, and it blew up in a lot of investors' faces. Pension funds, municipalities, all the people that were buying this stuff, retirement funds. So why is this relevant now? So many companies with poor creditworthiness have been able to take advantage of the low interest rate environment to finance their operations without having to make heavy interest payments. As rates rise, this could spell trouble for companies that are highly indebted, have a low cash balance, and have low to no profitability. So here's the $1 million tweet. I've been talking about the percent of companies in the U.S. are zombie firms, meaning that they pay more in debt service, aka interest, the obligation to service your debt or keep up current with your debt, costs more than they make in profits. So you can see here, this is from DataStream, WorldScope, and DB Global Research. Basically, since 2002, the dot-com bubble, you can see the rise of zombie firms, and especially since 2008, great financial crisis, it's gone up significantly. So we're over here in 2020, 2021, whenever this chart ends, and I promise you this chart is still continuing this trend up. So when interest rates rise, the interest payments rise, putting zombie firms in a difficult position to pay off their debt. This is no different than someone who takes on an adjustable rate mortgage thinking, hey, honey, interest rates are really low. We can pay this rate. It's locked in for 5 years or whatever the adjustable fixed term is. And then after year X, it's going to be based on a certain percentage at prime or at LIBOR or at whatever that benchmark is. And when that jumps up, X amount of percent, well, guess what? Your mortgage payment just went up by $300, $400, $500, $600, $700 a month, right? I'm just using that for sake of conversation. And now those people are going to default because they make the same money they made 5 years ago, but they can't afford the new increased payment because of the adjustable rate. This is no different than for companies. So default risk may increase significantly for companies with weaker credit ratings, and there are a lot of them. The secondary market. Bonds don't need to be bought directly from the issuer and held to maturity. Investors can trade bonds with other investors in what's called a secondary market. One of the most common ways to get exposure to bonds is by buying a bond ETF on an exchange. So there's Vanguard, there's BND, there's a million different ETFs that track the bond market. There's ones that track specifically companies, there's ones that track specifically municipalities or governments, but that's not the point of this right now. So bonds are starting to break. So let's look at some bond ETFs to see how the previously mentioned risks are starting to get priced in. So if you look at LQD, this is the investment grade corporate bond ETF. If you look at the 5-year chart, you can see that it started right around 120. It dropped significantly with cerveza sickness, went up significantly after trillions of dollars of historic money printing, and then now they're starting to drop again, as you see here in 2022, according to the chart. So even if you invested in the beginning of whatever this is, let's call it 2017, you're basically at the same exact level, 4 or 5 years later. So you have HYG, high yield corporate bond ETF. And the other thing I need to preface is with these charts, you don't see huge fluctuations with bonds. They're not like stocks. They're going to be much more stable. That's why the 60-40 risk parity portfolio, risk parity is just the fancy phrase for the 60-40 stock to bond ratio portfolio, which has been touted by personal financial advisors for years now. That's why it's usually the benchmark, because you want to have bonds and stocks and equities. Typically, when stocks go up, bonds aren't really doing much. When bonds go up, stocks are typically in a downtrend, thus balancing out your risk in your portfolio. So you can see HYG, if you want to look at 2017 again, or whatever the 5-year benchmark is, you can see here that it's just above $85. Let's call it 87. Fast forward 5 years later, you just lost 7.44% over this past 5 years. That's not, I don't think that's accounting for the coupon. This is just the face value of the ETF. So the blue line denotes November 30th, 2021, the day that the Fed adopted a more hawkish tone and decided to retire the word transitory when referring to inflation. So this is another thing. This is why the Fed is so important, dude. When you have YouTubers talking about what the Fed doesn't matter, these are people that just have no investing experience, period. The Fed is the market. I have a million videos on this. If you scroll through my videos, you'll see a video called The Fed is the Market. Rates dictate everything. Okay, interest rates dictate everything. So if you look at this blue line right here, which this gentleman is talking about, this is when they said they're most likely going to start raising rates and they're stop using the word transitory. You can see after this line, perception is reality, and you can see what these two funds have done. So it only took a few weeks for these ETFs to start grinding down as it became accepted that inflation will likely persist at elevated levels and that interest rates will be on the rise. Final thoughts. Bonds have been in a bull market for over 40 years, as seen by falling yields and increasing bond prices. While most investors see bonds as a safe haven, an investment that has worked for decades, the risks today are incredibly elevated. Bond ETFs are starting to break in the face of what seems to be an inevitable rise in interest rates and elevated inflation that will likely get worse with global crises such as Russia's invasion of Ukraine and continued lockdowns and supply chain disruption from the pandemic. It is likely that these risks haven't been fully priced into bonds, blah, blah, blah. Okay, so this video is incredibly important. Hopefully you watched until the end. I know these aren't like, the flashy thumbnails holding up bricks of money and saying, Tesla's going to 37x and you're going to be a bajillionaire and you're all getting girlfriends, right? And you can finally leave your mom's basement. I'm just kidding. Some people take offense to that. I personally don't care. So anyway, my point is that be careful, especially if you're an older viewer of this channel, what your exposure to bonds is. If you can see at the time of this recording, you're probably already feeling it. Full disclosure, I have like 5% of one of my portfolios as BND, which is VTI's bond index. That has gone down over the past couple weeks. But again, it's literally 5% of that portfolio. The rest is in the total stock market and other ETFs. So just be careful. A lot of financial advisors out there, they're used to the programming. They're essentially just glorified salesmen, to be completely honest, which is not taking anything away from their ability. Just be careful who you're working with because they've been trained to push the 60-40 portfolio. Typically, a good rule of thumb has been you take the number 120 or the number 110, subtract it by your age, and that should be the percentage of your portfolio in equities, in stocks. So if you're, let's call it 30 years old, you take 120 minus 30, 90% of your portfolio should be in stocks, 10% should be bonds, so on and so forth. So hopefully you got something out of this video. This entire video, I thought I was going to be burping because my wife had me try her dish that she made for dinner before the video started. I may put that clip in the beginning or at the end of the video, I don't know. But that was pretty funny. So as always, you guys, check out the links in the description below. Check out my university. It's going to be a private community where you're going to get 110% transparent access to exactly what I'm buying, when I'm buying it, what I hold in all my portfolios, not just what I choose to show on YouTube. It can also be looked at as almost like an exclusive mentorship. I have a lot of experience when it comes to career advice, breaking into finance, working in finance, entrepreneurship, all that good stuff. So I have a lot to give back with, but I'm not going to choose to put that up, necessarily 100% publicly, even though I've been doing it for 4 years now for free. So thank you, everybody. Check out the links below. And also there's an exclusive in March with the brokerage MooMoo. They're giving you multiple stocks for free. Check out the details down below. Thank you so much and have a prosperous day. I can't eat before I record. I'm going to start burping.
You gotta dig deep, bro. You gotta get a little bit of everything.
Ooh, that's good. Is there olives in here?
I made sure there wasn't olives in yours.
It's pretty good with the olives.
I know there's a loose one in there. Isn't it good with the olives?
Yes.
See, I told you. I knew. I know. That's good. You want this?
No, I gotta record, dude.
Okay. I'm on.
All right, bye.
See you later.
Dude, I'm gonna burp this whole time.